Hi guys. Today we will analyze Citigroup stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The long and short-term trends are both neutral. This gives a pretty neutral overall picture. Not much exciting going on here. Support level is around $62. Strong support levels are around $59.50 and $58. Resistance level is around $66. Strong resistance levels are around $67.80 and $69.80. In the last month the stock has been trading between $60 and $69 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 24.5 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why, our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $114.91. When we apply the margin of safety to that value, the fair value of the stock would be $80.43. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Citigroup is 10.14. Minimum rate of return. I will use 12%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Citigroup, analysts forecast growth rate around 3% per year in next 5 years, and future PE around 8. I will use 3 different scenarios for Citigroup company: bad, average, and good. First scenario. Citigroup will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future PE would be low, 8. In this case, the fair value of the stock today would be $35. Second scenario. Citigroup will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 10. In this case, the fair value of the stock today would be $48. Third scenario. Citigroup will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 12. In this case, the fair value of the stock today would be $62. As you can see, today the stock is a bit overvalued, $64, even if we expect Citigroup's high performance in future. The stock looks very valued. However, the revenue will grow only by 3% on average per year in the next 5 years. The stock has been on my watch list for a while and I'm tempted to buy it, but I think I'll wait until it drops below $55. For me, it's just about opportunity cost and capital allocation. You have many opportunities in front of you, so you have to choose what works best for you. Company strengths. Citigroup is one of the world's largest banks, with global consumer banking, corporate banking, and investment banking operations. The company has approximately 200 million customer accounts and does business in more than 160 countries. Like many banks, the company is reducing its physical footprint and migrating more customers to digital access. It also plans to rationalize card products and renew key co-branding relationships. The company has a nice yearly dividend yield of 3.18%. With its reasonably low payout ratio, 20%, Citi's dividend payments are well covered by earnings. The dividend grows each year by 10%, which is nice. Risks. Main risks are regulatory issues, consumer loan activity, and global recession. The company's relatively high exposure to emerging markets has historically added volatility and a higher risk component to Citi's earnings. In addition, plans for higher growth in the credit card segment may result in even faster growth in charge-offs, adding potential credit risk. Based on estimates for the next 5 years, Citigroup will show a small growth in revenue. The revenue will grow by 3% on average per year. The earnings per share is expected to grow by 1% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.